Is Bitcoin's recent rally a trap? According to Ben Cowen, we're perfectly repeating a historical bear market pattern seen in every midterm election year since 2014. He believes this is a classic counter-trend rally, predicting a potential drop back down to $40,000 after this fakeout. However, the Crypto Jebb channel argues that this time is different. He points to a major geopolitical shift calming global markets as the primary driver for this rally. With a key economic threat now off the table, he's targeting $80,000 next. Who's right, the psychoanalyst or the macro trader? In the latest video from the Ben Cowen channel, the discussion centers on how Bitcoin's market behavior feels like a simulation because of its incredibly repetitive cycles. Cowen points out a recurring pattern in midterm election years. The market typically finds a low in February, which is followed by a rally in early March. He shows how this exact sequence played out in 2014, 2018, and 2022, and it's happening again now. He argues that bear markets are tricky and fool both bulls and bears, often featuring powerful face-ripping rallies that convince people the bull market is back. However, he believes this is just a counter-trend rally and that Bitcoin is still in a bear market. He expects the price to form a lower high in March before heading down to new lows later in the year, possibly into April. While he mentions potential resistance around the $74,000 level, his main line in the sand is the bull market support band, which is currently in the $80,000 region. He doesn't know where the rally will top out, but suggests a drop to $40,000 could be the next major low. Ben Cowen's analysis of historical cyclical patterns provides a compelling framework, suggesting the recent strength is a classic bear market rally. This perspective is particularly interesting when viewed against the current market backdrop. Recent data shows a significant reversal in Bitcoin ETF flows, with a net inflow of $225 million on March 3rd, following a period of heavy drawdowns. This renewed institutional appetite, led by BlackRock's IBIT, could challenge the historical pattern Cowen outlines. However, the market sentiment remains in a state of extreme fear, and the price is still highly correlated with U.S. equities, which face their own geopolitical and economic pressures. On the regulatory front, there's growing momentum. The OCC has proposed rules for stablecoin issuers under the Genius Act, and there are bipartisan efforts to provide legal clarity for software developers, signaling a maturing industry. This push for regulatory clarity, combined with significant institutional moves like Tradeweb entering the crypto space, suggests a solidifying foundation for the asset class. The key question is whether these fundamental developments in institutional adoption and regulation are strong enough to override the historical midterm year precedent that Cowen's analysis depends on.
In the latest video from Crypto Jebb channel, we get a breakdown of why Bitcoin suddenly rallied up towards $73,000. It all kicked off when the U.S. stock market opened, and it seems the panic surrounding the conflict in Iran is starting to cool down. A huge part of this is the economic worry tied to the Strait of Hormuz, a critical channel for about 20% of the world's oil and a big chunk of its natural gas. The conflict caused a 10% jump in oil prices in just 5 days, sparking fears of widespread inflation. The big shift happened after Donald Trump announced that the U.S. would provide political risk insurance for all ships in the Persian Gulf, essentially guaranteeing the flow of energy to the world. This news allowed the markets to relax, as one of the biggest economic threats seemed to be contained. With this fear subsiding and previous market manipulation from James Street seemingly over, the outlook for Bitcoin has turned much more positive. The previous prediction of a drop below $60,000 is now being updated. The new expectation is for Bitcoin to climb back to $75,000 and then make a push for $80,000. While a final dip is still possible, the long-term view is very optimistic, with targets for the next bull market sitting between $200,000 and $300,000. The analysis in the video hinges on a specific geopolitical event and a singular political statement calming market fears. Looking at the current situation, this narrative holds some weight. The announcement that the U.S. would backstop maritime insurance in the Persian Gulf did provide a short-term sigh of relief for energy markets, as confirmed by reports from early March 2026. This helped pull oil prices back after an initial spike and allowed risk assets like Bitcoin to bounce. However, the market's reaction also highlights Bitcoin's continued and even strengthening correlation with equities like the S&P 500. During the initial panic, Bitcoin sold off with stocks, acting more like a high-beta tech play than the digital gold safe haven it's often called. This connection means that while calming oil prices is a positive, Bitcoin's fate remains closely tied to broader macroeconomic sentiment, which is still navigating uncertainty. While the $80,000 target mentioned is a hot topic among analysts, with some technical patterns supporting the move, the path there isn't clear. The market structure has shown some resilience, with institutional buyers treating dips as opportunities, but the overall sentiment is still one of extreme fear. The idea that two big bads are completely off the table might be premature, as the underlying geopolitical tensions haven't vanished, and market structure can be fragile.
After breaking down two very different takes on Bitcoin, a clear battle of narratives emerges. Both analysts see the $80,000 level as a major line in the sand and agree the market is at a pivotal, volatile moment. But the core disagreement is why it's moving. Is this a classic bear market rally, driven by predictable historical cycles? Or is it a new leg up, fueled by fading geopolitical fears and renewed institutional interest? The big question is whether today's fundamentals are strong enough to break the patterns of the past. Your key takeaway is this: decide if you're betting on history repeating itself, or if this time it really is different.